Hello, everyone, and welcome to the Findley Davies BPS&M Next Generation Retirement Plan webcast. If you have questions during the webcast, please type them in the chat area, which is accessible sometimes in a hidden toolbar at the top of your screen, oftentimes in the upper right. We'll address all questions at the conclusion of the webcast presentation as time permits. This webinar is being recorded, and the recording will be available on the Findley Davies BPS&M website by this Friday. You'll receive a link to the recording as well as a link to the presentation slides by the end of this week. Today's topic is complex, and our goal is to make it as easy to understand as possible. So let's dive right in. Our presenter is Matt Klein, a credentialed actuary and principal in the Findley Davies BPS&M actuarial practice. He is a frequent presenter and an author on evolving pension plan strategies. And he also co-authors our firm's monthly pension indicator, which tracks the impact of corporate bond yields and stock market performance on the funded levels of pension plans. And now, I'll turn things over to Matt. Matt?
Great, thanks Lisa. Good afternoon everyone, or good morning depending on the time zone that you're in. I appreciate everyone sitting in on the webinar today. As Lisa mentioned, we have 45 minutes to get through a lot of material, so we will jump right into it. So, there's going to be some presumption here that most people know the basics of defined benefit versus defined contribution plan, but just really the 20-second overview. With a traditional defined benefit plan, benefits are generally determined as an annuity payable for life for the participants in the plan, and an actuary helps the plan sponsor develop the contribution strategy needed to fund those benefits. In a defined contribution plan, truly the contribution is defined. So the employer is putting in X% of pay each year, and that account balance then grows based on how the employee, the participant, invests the money and takes out a lump sum at retirement. So, those have been the two traditional tenets of retirement plan design. Now we want to keep that in mind with the context of the risks that we're looking at. Now, the first two risks here, the regulatory risk and the operational risk, these are risks that can't be diversified, or just the merely having a plan subjects you to potential rule changes, accounting changes, DOL, interpretations, and the operational risk in terms of compliance and those kinds of things that just sponsoring a plan you have to deal with. The last three risks here, the demographic risk, interest rate risk, and market risk, these can be managed either by the employer or by the participants based on how your plan design is set up. And it's the distribution of these risks that we really want to talk about when we look at the variable benefit concept and why it makes sense as the retirement plan moving forward. So historically, we've got our defined, we've had this bridge, or we've had these two islands with no bridge connecting them in the middle. We've got the DB plans on one side and the DC plans on the other side. With the DB plans, all the risk has been with the employer. All that investment, interest rate, mortality risk has all been with the employer. And conversely, on the defined contribution side, the employer just puts in that contribution, and then it's up to the participant to manage the mortality risk, interest rate risk, investment risk, and so we've had this big divide traditionally. So, back in the 80s and really more the 90s, we had cash balance plans that came into play that were meant to be this hybrid plan to try to bring the two islands together over this bridge. And the way they distributed those risks were putting the DB plan would keep the market risk and the interest rate risk. So the plan sponsor is still subject to the market fluctuations, and the participant is subject to the demographic risk, meaning that the cash balance plan generally pays out an account balance when the participant terminates or retires from the company, and then they manage that pool beyond that point. So let's take a second to think about whether this allocation makes sense. What's the plan sponsor's biggest fear? If you talk to anyone in the finance side of the house, they will tell you that their biggest worry in a retirement plan is having a significant market correction that's going to force the employer to contribute significantly more to the plan, and almost always this happens at unexpected times. When there's a downturn in the market, generally that's a sign of a recession, and we're asking plan sponsors to contribute even more to the pension plans at the time the cash flow is tight or business is down. From the participant side, their biggest fear, if you look at, any number of surveys, the number one fear is outliving their money. So, with a cash balance plan, that participant is taking their money at retirement and then they have to manage it for the remainder of their lifetime. So this bears the question of why would you implement a plan where both sides, the plan sponsor and the participants, are retaining their biggest fears? And is there a better way to design a hybrid retirement plan? And that's really where the variable benefit plan comes from. So the idea is to shift around the cash balance model in terms of shifting around the risks that the variable benefit plan is undertaking. We are keeping the demographic risk in a variable benefit plan with the plan sponsor, and that the benefit is defined as an annuity for life of the participant. So the employer is retaining that risk. On the other side, the participants in the plan, they're the ones that are going to bear the market and interest rate risk moving forward. So let's talk for a second about why this is a more appropriate way to spread the risks out. So, the average life expectancy for a male currently age 65 is 22 years, but there's a high degree of variability at the individual level. A participant can live to 100 or they can get hit by the proverbial bus tomorrow. So a plan sponsor that has many lives and can pull those lives together, the more lives we get together, the more that the life expectancy resembles a normal curve. And with a normal curve, from your basic statistics class, the more stable and the more predictable those costs become, the more people we can get in the same pool. So from a plan sponsor standpoint, keeping the mortality risk is something manageable. And then for the investment risk, that market risk, that's pretty well accepted by most participants in today's age. Vast majority of participants are in defined contribution plans in 2017 as opposed to defined benefit plans. So they're used to having that market risk, and they, a lot of participants lived through 2008 and survived that. It caused some issues along the way, but we've worked through that, and participants are used to seeing their account balances fluctuate. Finally then, when there is that market downturn, reducing each participant's benefit by a little bit becomes much more manageable than looking for the plan sponsor to come up with millions in extra contributions. Think of the old proverb that many hands make light work. If we are spreading out that market risk over the participant pool, everyone sacrifices a little as opposed to putting all of that on the employer. So with the variable benefit concept, we still have the DB plan assets in one pool, like a traditional DB plan, and so those assets are being professionally managed as opposed to the defined contribution model where that's all done at the individual level. You have certain individuals who will go 100% in equities, and you have certain people who do 100% in cash. So we've seen, and the statistics prove, the studies prove that that professional management leads to superior results, and ultimately what that, those superior returns mean that a plan sponsor can provide the same amount of benefits at a lesser cost. So that's looking at a high level of, kind of the risk sharing of how the variable benefit plan works. So now we're going to get into a little bit more detail as to a little bit more into the weeds as to how this thing actually, how we accomplish what we're talking about in this risk sharing. So the key concept when we're looking at the variable benefit plan is determining this hurdle rate. So this hurdle rate is a key driver in determining both the cost of the plan and the richness of the benefit. And that hurdle rate becomes the bar, the standard by which we determine whether benefits are increased or decreased every year with the asset return. So when we look at an actual accrued benefit in a variable benefit concept, we really have two key pieces here that we want to look at. So we've got the adjusted prior year benefit that's being affected by the investment returns, and we have the current year accrual. So the current year accrual is the easier piece to talk about. This is just what the participants are earning in the current year, and generally, I recommend this is set up, to be something like 1% of pay, and so that it accumulates like a career average plan or a 401k design where it's based on current year pay. The part that takes more to explain is this adjusted prior year benefit, and we are adjusting that benefit up or down based on how the returns in the plan, the returns on the trust assets are compared to that hurdle rate. So, if we look at our little bit of algebra here at the bottom of slide 12, we have our accrued benefit at time 1 is dependent on our accrued benefit at time 0, and we're adjusting that. We're growing it by the returns and measuring that against the hurdle rate. So if the return equals our hurdle rate, we get that nice cancellation there, and there's no adjustment to the accrued benefit. If our return is greater than the hurdle rate, now our numerator is greater than our denominator and the benefit increases, and conversely, if we don't get the returns or below that hurdle rate, we're going to see the benefit decrease. So this is where we talk about, the hurdle rate determining the richness of the benefit. The higher the hurdle rate that you have, the lower the promise is, because, it becomes harder to get those higher realized earnings on the trust. One quick techie note, if you set your hurdle rate of at least 5%, it does exempt the plan from the statutory hybrid regulations that the IRS released a couple years ago. So there was, some thinking in those IRS regs about these kinds of plans. So they set that if the hurdle rate's at least 5%, it exempts you from those statutory rules. Most consequently, would be the 3-year vesting that we now see in cash balance plans would not apply to the variable benefit concept. So Let's take a look at a simple example. So we're going to ignore the accrual rate portion of our algebra here for 1 second and just focus on how the benefits adjust each year. So we're going to take our sample person here at age 45, and they're starting out with a $1,000 benefit. Now, and you'll see consistently here that our hurdle rate throughout the time period is 5%. The hurdle rate is determined in the plan document. It's specified by the plan sponsor, and it's not something that is subject to fluctuations based on what's happening in the market. So that's an important key to remember, that the employer is retaining that lever and that kind of control. So in the first year, the participant, or I should say the plan's assets return 7%, which exceeds our hurdle rate of 5%. And so what we see then is the benefit going up by roughly 2% from the $1,000 to $1,019 at age 46. What we see in year 2 is our return is only 3%, which is below our hurdle rate of 5%. And so we will adjust the benefits accordingly down a little bit since we did not meet that hurdle rate. And lo and behold, our benefit for age 47 is $999. Now, it's not coincidental. We kind of purposely, set up this example that in the first year, the return is 2% above the hurdle rate, and in year 2, the return was 2% below the hurdle rate. And what you see is you basically end up at the same point as you did 2 years ago. The $1,000 versus $999. So, so this does self-adjust based on how the market returns do. And correspondingly, you can see then how the math works through the rest of the example. We come here, we have our $971. We have a good year of 11%, and we see a nice jump in the benefit to $1,026, and so on and so forth through the rest of the example. So that's how the benefit is affected. So when we go now and look at how the assets and the liabilities tied together, you'll see this nice sinking action. So this is the same example as on the previous slide. You'll see the benefits here are moving at the same rate. We're still keeping the same returns as we had on the prior slide, and we're keeping our hurdle rate of 5%. But what this is showing is, what this slide is showing is the liability and the asset growth of that $1,000 benefit. So when we're looking at this $1,000 benefit at age 45, payable at age 65 when the participant retires, currently the liability or the present value of that promise would be $6,017. And assuming we start off at a fully funded status where our assets are equal to $6,017 as well, we have our funded status right there at 100%. And the asset returns are controlling the growth or decline in the benefit, but when we have a good year, we have our asset return of 7%, we see the assets are growing by exactly that 7% from 6,017 to 6,438. So this growth in the benefit of $19 is fully supported by the growth in the assets. And so our present value, our liability for the plan has gone up, but it's only gone up because the assets have grown to support that. At all times, the plan is maintaining that 100% funding status. And so it works in the reverse, too. The year we only have 3%, we decrease the benefit because we didn't get the asset return that we were expecting. So the present value for that 47-year-old of this $999 benefit is $66.31. And the idea here is that at all times the present value is equaling the assets, keeping the plan, keeping the variable benefit plan fully funded at all times. And you'll see that through through the rest of the example if you go through the math. So So that's looking at the benefits, so you can understand how the assets and liabilities work together. So now we're going to add a little bit of complication, and now we're going to add back in the accrual rate so that you can see how the participants are seeing their benefits really grow. A new example here. So in this example, our hurdle rate is 6%, and our accrual rate is 1% of pay. So we've got our formula here that you've seen on previous slides. And we're going to start at age 50 with our sample participant here that has a monthly benefit of $500. And in the first year, the assets are going to turn exactly 6%, which happens to be our hurdle rate. So we know that when the return and the hurdle rate are exactly equal, there's no adjustment to the monthly benefit. But we do have our accrual rate now that we're introducing, which for our participant making $40,000 a year, divided by 12 and times our 1% of pay is $33.33 accrual, and that's what we see then at age 51 as the monthly benefit. There's been no adjustment to the $500 because the asset return was equal to our hurdle rate, and we've just added in the 33 monthly accrual. And so in year 2 now, the asset return is 0%. So that does decrease the benefit, the monthly benefit, but we're still adding in our accrual for the year. So our participant received a pay increase to $41,000, and correspondingly the monthly accrual rate increased to $34.17. So we've got a decrease in the benefit due to the asset return, an increase due to the monthly accrual rate, and it nets out that at age 52, our participant sees a slight increase in the monthly benefit from $533 to $537. In the following year, what often happens, we have a rough year in the market, it's followed up with a good year. So we have a 15% asset return, and we add in our $35 monthly accrual rate, and you can see that the monthly benefit has a nice jump of $80 from $537 to $617 in year 3. Now, that's an $80 increase in the monthly benefit, but again, from an employer plan sponsor perspective, we haven't increased the cost. What the plan sponsor needs to contribute is going to be just this monthly accrual rate. The rest of the increase in the benefit is fully supported by the asset return that was earned on the plan's assets. And if that asset return isn't there, as we saw in the year before, then the increase in the monthly benefit will be much, much smaller. So the idea here is that while the monthly benefits are going to fluctuate, the plan sponsor's cost is going to be very stable throughout the lifetime of this plan. So to try to show this example a little bit further, we have yet another example where we are looking at a hypothetical participant who was hired at age 30, making $40,000 a year, and they're going to retire at age 65, and we're going to give this participant a 3% pay raise each year. So I've developed a final average traditional pay DB plan, a defined contribution plan, and a variable benefit plan at different, you see different percentages here. But the idea is that at age 65, all 3 of these plans, based on the assumptions that were built into the model, will provide the same amount of retirement income at age 65, regardless of the plan design for our hypothetical participant. So as we look at the 3 designs, again, paying the same benefit to this hypothetical participant, we look at the contributions over the 35-year working career of this employee, and then we're going to discount those cash flows back at a 6.5% discount rate. But when we do that, looking over the 35-year career, we can see that the variable benefit plan is the cheapest of the three options. The traditional defined benefit plan turns out to be the most expensive on a present value basis. The defined contribution plan is cheaper, but the variable benefit plan ends up being the least expensive of all three models. Continuing this example on to the next slide, we're really here focusing on the first 10 years of employment. So for our 30-year-old, we're looking at from ages 30 to 39. And in our graph here, the defined contribution plan is the orange line that is much higher than our other two lines. We've got our variable benefit plan is the blue line, and the traditional DB plan as the gray line. So what you can see here is that for the retirement plan experts on the call, you're already familiar with this concept that the defined contribution plan in the early years of employment is much more expensive than either a DB plan or this variable benefit plan design. What we see is the idea both in the traditional DB plan and in the variable benefit concept is you are rewarding your older, longer service employees. So if you when you have your younger employees that are not going to be career employees, they're leaving after 5, 7, 8 years, and they leave the organization and they take their 401k money with them, you're generally giving them a much richer benefit to someone that is not part of the long-term plans of the organization. So in terms of where you're spending your dollars, the variable benefit plan is putting more emphasis on your older, longer service employees, the ones that generally tend to be the real movers and shakers of your organization. So you're putting in your reward structure to be similar to that. So really what we have seen is, hopefully what I've demonstrated through the course of this is that, what the variable benefit concept is we've produced a stable cost defined benefit plan. So if we talk to, plan sponsors, almost inevitably the two top things on their list of things of what drive them crazy about a traditional defined benefit plan are the investment risk and the interest rate risk. So that investment risk, we have now passed that along to the participants. And again, the participants are much more accepting of that market risk, especially with the prevalence of defined contribution plans in the marketplace. And with the interest rate risk, we're also seeing that through the concept of the hurdle rate and how that interacts with the returns and how we develop the liabilities of the variable benefit plan. We get a stable interest rate. And so we've eliminated that risk. So what that does is it eliminates the volatility that plan sponsors, especially on an accounting basis, we see significant fluctuations year to year as corporate bond interest rates or treasury rates move significantly from one year to the next. So remember, the plan sponsor gets to choose the hurdle rate when they set up the plan. They also get to dictate when, if ever, that hurdle rate changes into the future. So again, very predictable cost structure for the plan sponsor that simply just can't be achieved in a traditional defined benefit plan. If we talk to those same plan sponsors of defined benefit plans, certainly the investment and interest rate risk are the first two things out of their mouths, but a very close third would be, certainly for the last couple of years, is the significant increase in PBGC premiums. As you can see from the chart here, and is pretty well advertised in many different studies, through 3 different congressional actions this decade, the variable rate premium portion of the PBGC premium has increased from $9 per $1,000 of underfunding, and it's projected to grow to $42 per $1,000 of underfunding by 2019. So a 367% increase in that variable rate premium. So the key to understanding the variable rate premium, and that variable rate premium generally, certainly for underfunded plans, can be as much as 80% of the total PBGC premium for a plan sponsor. But that variable rate premium is only paid on unfunded vested benefits, and therefore a plan with no unfunded benefits has no variable rate premium. And so, you know, one of the beauty of the variable benefit concept, by taking that investment risk and the interest rate risk off of the table for the plan sponsor, the variable benefit plan is by design set up to be close to, if not 100% funded at all times, and so managing the PBGC premiums becomes so much more manageable when you only have to deal with the per participant rate, which is, as I mentioned, is the much smaller portion of the PBGC premium compared to variable rate premiums. So significant. We've thought through that issue as well when we're designing this concept. So in terms of, hopefully over the first half hour here, I've shown some of the power of the variable benefit concept. So if you're looking at implementing a change to a variable benefit plan, for your existing DB plans, you can move to the variable benefit design on a prospective basis. It does not mean you need to completely terminate your existing DB plan and set up a brand new plan. The variable benefit concept can be worked into the existing DB plan. But again, only on a prospective basis. The Internal Revenue Code rules and regulations being what they are, we can't apply that retroactively. And for an existing DB plan, they could keep the existing accrual pattern if you want, or you could look to employ more of the variable benefit design, basically meaning go to a pay structure that works on current year pay rather than the traditional final average pay DB plan. Certainly either design can be done, but if you're going with the career average plan, helps keep some of that inflation risk off of the plan sponsor side of the house, and again gives more predictable, more stable costs. So this plan design does require a pretty well-worded plan document to get all the pieces, parts worked into the plan document to get this to work correctly. So if you're looking to implement one of these designs, certainly want to look to a provider or sponsor that has done this kind of plan design before and knows all the proper caveats to put into place. So what we really see here with the this the main final slide here is, the variable benefit plan is set up to really be the best of both worlds. When we look at the traditional defined benefit plan and the traditional or just defined contribution plan. So, we've listed here a lot of the challenges that many plan sponsors are looking at for the PBGC variable rate premiums, as we've just discussed. we've eliminated those, or at least significantly minimized those compared to the traditional DB plan. We've taken the employer investment risk and interest rate risk off of the traditional DB plan as well. But we're also taking some of the good things from traditional DB plans and we're taking those away from some of the challenges of the defined contribution plan. Where we have, in the defined contribution plan, the employees are in charge of managing their own money. With the variable benefit plan, we're keeping that to the professionals, to the investment advisors out there to provide those superior returns that they can generate. We're also, because the benefit and the variable benefit plan is designed as an annuity, not as an account or as a lump sum base notional account. By defining it as an annuity, we're keeping the longevity risk with the employer, which is much more easily managed, as we talked about, than it is in the defined contribution model. You know, in the defined contribution model, there's been talk for years about trying to, you know, come up with annuitization options within the defined contribution model. We've seen some slow acceptance of those, but certainly nothing has been widespread in terms of trying to annuitize that DC balance. And but we don't have that worry with the variable benefit concept. The volatile funding pattern that we generally see with DB plans, because they are subject to the investment risk and the interest rate risk, we don't see that with the variable benefit concept. Again, the plan sponsor gets to pick that hurdle rate, so they have a consistent structure in what they're looking at for their funding pattern. The funding pattern is, you know, as predictable as a defined contribution plan, and some would argue it's even more predictable. The loss of purchasing power, so, you know, inflation protection, you know, in most defined benefit plans, we don't see any inflation protection, any COLAs. We do see that in the public or government area, but we see very little of that in the private sector. In the defined contribution model, you know, that inflation protection is really dependent on how that individual participant manages their money. And with the variable benefit concept, again, you know, it's somewhat dependent on our hurdle rate, but the idea is you set a reasonable hurdle rate, and more years than not, the market will outperform that hurdle rate, and participants will see a little bit of increase in their benefit over the years. That does provide some sort of inflation protection in the variable benefit model that really doesn't exist, certainly not explicitly in either of the other models. So in terms of rewarding short service employees, as we showed in the one example, the defined benefit and variable benefit plans are much cheaper in the earlier years than the defined contribution model. And finally, the last point here is talks about leakage. And what we mean by leakage really from kind of a public policy standpoint is a lot of times in the defined contribution model, we have participants that have put some money into the plan. They leave their employer after 7-8 years. And instead of rolling that money over into an IRA and keeping it dedicated to for retirement uses, we see far too often participants use that retirement money for other purposes, whether it's to pay for a new car or their wedding or to invest in their children's college education. We see these dollars that were dedicated for retirement. We see participants taking, you know, the significant tax hit of taking it in cash and then using it for non-retirement purposes. So with the variable benefit concept, you know, we don't see that kind of leakage, and the money that is set aside for retirement, participants will get that money at retirement when they need it. So the idea here is the variable benefit concept really does solve a lot of problems and is really a nice model going forward for us. So hopefully through the course of this, you can hear some of the enthusiasm that I have for this benefit design, and I'm very hopeful that these kinds of plans will start to take off, and we do this as some of the thought leadership of Findlay Davies BPS&M to educate the public, our clients and prospects about some of the new ways, providing some of that thought leadership and new ways of designing and engineering retirement plans. So certainly, if anyone has any questions for me, I would be very open to talking with you individually or with your organization about further details on how these plan designs work, how they might actually be implemented for an individual employer or sponsor. I think there's applicability here with these plans both in the private side and also on the public government side as well, where there's a lot of debate. We see a lot of debate on the, traditional defined and defense of the traditional defined benefit plan. We see, increasing challenges with introducing a 401k defined contribution type concept, that perhaps a variable benefit plan design with that risk sharing is more palatable for both the participants in the plan and to the taxpayer supporting it. So with that, there's just a couple minutes left here, and I will thank everyone for their attendance and for listening in today, and I will turn